Hello, I'm Hickey from Interest.co.nz and welcome to a special report on fixed versus floating ahead of the Reserve Bank's decision on Thursday about interest rates. Now, the official cash rate is the base for all interest rates in New Zealand, and often the floating mortgage rate moves in tune with the OCR, but not always. The fixed rates tend to move with what's happening in the wholesale interest rate markets, in particular swap rates. But it's interesting to watch the Reserve Bank's monetary policy statement on Thursday to get a sense of where interest rates are heading and what you should do, whether you should fix or you should float. Now, the Reserve Bank is expected to hold the official cash rate at 2.5% on Thursday morning at 9 o'clock. And keep an eye on our site to find out what the Reserve Bank has said. The key, though, is the outlook for interest rates. Most people are expecting the first interest rate hike to be in December the 6th to be exact. And they're looking for the OCR to rise from 2.5% to around 4.25% over the next couple of years. But it's how quickly that OCR rises and how soon it gets to that peak that is the key. Now, economists are saying you could get to that peak, 4.25%, so that's up almost 2%, by the end of next year, 2013. But the markets, those people trading interest rate securities, say it may not be until 2015. And there is one outlier. Westpac is saying that the peak in the official cash rate could actually reach 6% by 2015. Now that suggests, according to Westpac, you'd be better off fixing for 2 to 4 years. Remember, if we see the official cash rate rise from 2.5% to 6%, that implies a floating rate which is 3.5% higher. That's talking about a 9% floating rate. So obviously, if you're looking at a 2-year or a 4-year fixed deal, which is around the 6% mark, you'd be much better off. But of course, will rates rise that fast, or will they stay lower for longer? Now that's the key question anyone should look at when they're considering whether to fix or to float. The markets are saying we'll see a 25 basis point increase in the official cash rate later this year, in fact within the next year. And they're saying that it will rise relatively slowly. Economists, meanwhile, though, are saying interest rates will rise faster. All of this depends on the outlook for growth and inflation, and we really don't know what that's going to do, particularly with all the dramas we've seen offshore. Now, the economists are saying that on Thursday, the Reserve Bank may soften that view about a December rate hike. However, the Reserve Bank is likely to try and push the market, nudge the market to say, yeah, we might start hiking later, but when we do, we'll do it faster and we'll peak a little bit higher than what you're expecting. The key, though, in Thursday's announcement is to watch the 90-day bill forecast track. And the Reserve Bank doesn't tell you what it's going to do with the official cash rate, but it does forecast the 90-day bill rate, which you could argue is a proxy for what the official cash rate's doing. Now, over the last couple of weeks, we've seen some moves in the wholesale interest rate market. They've risen about 30 to 50 basis points. And I'll just show you a chart which is on our site, and you can link to it from the article below, which shows you the 2-year swaps rates, which is what the fixed mortgage rates are based on. And you can see here that a couple of weeks ago, they bottomed out at about 2.67%. That's pretty cheap for a 2-year swap rate. And then they've started rising. So they've risen from 2.67 there up to around about 3.1% in the last 3 or 4 weeks. Now that's a sign, some say, that, wow, interest rates are on the move. Remember, the general environment is that overseas people are feeling a bit less nervous about what's happening in Europe. We're seeing some good signs coming out of the United States, and even the Chinese are saying they can avoid a hard landing. So maybe, some say, we're out of the worst of the global financial crisis, and that would push interest rates up. However, we've been here before, and it's worth having a look at what's happened to the average fixed rates over the last 3 or 4 years. Some of you might remember back in early 2009, there was a big drop in fixed rates. In fact, we got down to, for the 2-year, an average of 5.9%. Now that's about where it is now. And we saw a big rush in March and April of 2009 into those fixed rates. And what happened? Well, interest rates didn't rise very quickly. In fact, they only rose a little bit, and then they came back down again after the earthquake in 2011, and in fact they stayed lower for longer. The global financial crisis was supposed to be well over by now, but of course we had the second round of problems through last year. So those people who fixed at 5.9% back in early 2009, just around about here, would actually be slightly worse off than those people who were floating through that period. In fact, people who are floating are now getting about 5.6, 5.7%. So the question is, when you look at whether to fix or float, you've got to look at your view on future interest rates. And that's a tough one to know. And of course, there's lots of different views. If you think that interest rates stay lower for longer, that we're in for a very long recession, that it's going to be very tough, then floating might be a better bet. If you think we're in for a real rebound, that interest rates are going to rise reasonably quickly into a high peak over the next couple of years, then fixing makes sense. And when you look at what happened with the 5-year average rate, let's have a look at our chart here for average 5-year rates going back a few years. You can see here some people took advantage of rates going to 6.4% in February 2009. It didn't stay there for very long. When everyone rushed to the exits, interest rates surged up to 8.5% within a year or so. Those people who jumped in for 5 years at 6.4% may have felt brilliant right then, but they would still be sitting on losses over the last 2.5 to 3 years because interest rates for floating rates actually went well below 6.4%, a full percent below. So it's a tough one, fixed versus floating. Sometimes it'll depend on your personal situation. If you're really keen to ensure you have a fixed amount you pay every month for the next 2 years, then fixed can make sense and you can give up whatever you lose if floating rates drop. However, if you think that interest rates stay lower for longer, which is my personal view, then you'd look to stay floating, and that's what we're doing. But of course, if you think interest rates rise quite quickly, then fixing makes sense. It's a tough one, fixed versus floating, but keep an eye out on Thursday morning at 9 o'clock for the latest from the Reserve Bank on interest rates. Remember, they set the tone and the base for interest rates. I'm Hickey. That was a special fixed versus floating report here at interest.co.nz.